All right, so here it's important to know a lot about debt securities. Remember, debt is loans, IOUs, right? You're lending the company your money as an investor. You're not participating in ownership. It's not equity. It's debt. So you, an investor, loans money to an issuer, which is a corporation, or many types of issuers that send out bonds for people to invest into. There are many different types of issuers, and each type of issuer comes with their set of rules on how they issue their bonds and the whole process of that. So always connect IOUs, fixed income. The purpose of debt securities and bonds is to pay an income, often an annual income, based off of a set percentage that the company decides what rate they would pay you an income for the longer they keep your money invested. So, basic bond characteristics. You want to remember the par value of a bond. Most debt securities have a par value of 1,000. Another name for par value is also called the principal or face value. So one bond equals 1,000. You want to think if somebody buys two bonds, that's 2,000. If somebody buys 20 bonds, that's 20,000, right? Because each bond has a par value, a face value of 1,000. So any calculations like a current yield or how much you would get paid annually with a coupon rate is based on the par value. And as you can see, coupon rate, fixed interest rate issuers promise to pay annually. So when you invest into a bond, you're lending your money to that issuer. Anytime anytime there's lending of money going on, right? The lender will always get paid back plus interest. So they would get paid their principal amount back along with any interest payments that were received, as you see, annually for every year that that bond stays invested into. You want to remember the coupon rate is a nominal yield, a stated rate. In other words, it's a point that never changes. So companies decide this before they issue the bond. They decide what would be the coupon rate we're going to attach to this bond, right? So once they decide that coupon rate before they issue it, once they issue it, that rate stays the same. So a 6% coupon means that you just take 6% times 1,000 par value of a bond. That means the issuer will pay that investor $60 a year for as long as they keep their money invested into the bond. And then when the bond ends, that is what's known as a maturity date, which is the date the principal is repaid. So if you bought one bond, that 1,000 principal that you invested gets repaid at maturity date. You just want to think that's the end of the loan agreement. Let's say they're like, hey, invest into this bond for 10 years. We'll pay you 6% every year. Once those 10 years are up, you get your initial principal back. And plus, you would have made some extra income those years you were invested, such as a 6% rate or, an 8% coupon rate. It's whatever the company decides before issue. So just remember, maturities are just when a bond ends. It's when it matures. No longer an active loan agreement, you can think. There's different types of maturities to remember. You have term bonds, serial bonds, and balloon bonds. Term bonds, the principal gets returned at maturity. So if you're going to be invested for 10 years, then you'll get your principal back on that 10th year. And then you have serial bonds where instead of getting it all at once at maturity, you'll get some of it little by little over time. So just think it's more repetitive. Serial bond payments are more repetitive. They'll pay you little by little over intervals of time, over periods of time until you get your full principal back. It's like somebody's just like, hey, I can't pay you it all back right now, but I'll put me on a payment plan. I'll pay you it back little by little over time until it's fully repaid. So that's serial. And then balloon bonds is a combination of term and serial, where they'll start off with paying little bits off, but the majority of the principal will get paid at final maturity. So it's a combination of both. Term bonds, it pays all at once at maturity. Serial bonds repay little by little over time until fully repaid. And then balloon bonds starts off small, paying little at a time, but then it'll pay off the big amounts at maturity. So you want to think how a balloon starts small, but then gets big. So the payments start small until they reach the final maturity date. They'll pay it all the rest on that date. The interest rate that the issuer promises to pay when a bond is issued is, so this rate is set once again before they issue a bond. This is the company's promise to pay you, which would be the coupon rate. Back to that 6% coupon rate. That'll be their promise to pay you $60 on an annual basis if you purchased one bond. You just take 6% times 1,000 par value. And then here, second question, your customer calls you with a question. The customer tells you that they received a phone call from the bond desk telling them that a trade to purchase 20 bonds at 100 has been executed for their accounts. The customer would like to know how much they paid for the bonds before any commissions or other charges. The answer to the customer's question is, well, this one's pretty simple. If you know a bond's par value is 1,000. So if you have one bond, that's 1,000. If you have two bonds, that's 2,000. So if you have 20 bonds, then the customer would pay 20,000. And that 100 that you see, that means is just at par value. So they purchased 20 bonds at par. So you would just add a little zero at the end of that 100. And then you just do 20 times 1,000. 20,000. When it comes to yields and interest rates, like I said before, that nominal yield is the coupon rate. It's the point that never changes. It is the dot that always stays the same, no matter what fluctuations happen around it. Interest rates are what can fluctuate or go up and down all the time, which has an effect on price. Price can also go up and down because it has an opposite relationship to interest. Then you have current yield. Current yield is one of the calculations that you would have to do. Current yield, you would just take the annual coupon payment and then you divide it by the market price. So let's say it was a 6% coupon. That'd be $60 a year annually. So you would take that $60 payment and you divide it by whatever the market price is at that time. And that's how you find the current yield. Yield to maturity is no calculations required really. Just know it's just the total return if you held your bonds until maturity. So it's just like, what's the total income, the total value you are able to receive being invested in that bond until the bond had ended, until it matured. So think the annual payments you were receiving plus the return of your principal would be your total return at maturity, or your yield to maturity. Yield to call. Some bonds are issued with what is known as a call feature. A bond with a call feature may be redeemed by the issuer before maturity. When a bond is called in by the issuer, the investor receives the principal back sooner than anticipated. So you want to think a call feature is basically if a company or the issuer of the bond basically feels like they owe too much interest to the investors into that bond. So let's say you get a corporate bond and their coupon rate is 6%, meaning that's what they'll promise to pay you every year. But then they see on average with other bond issuers, they're issuing bonds at 4%. So they see other issuers have a lot lower promise to pay than they do. What would you do in that situation if you were that corporation? You would call the bond back so you can reissue it at a lower promised rate. Does that make sense? So issuers call when interest rates fall. It could have started at 6%, which was probably the average rate for other bonds, but then they see around them rates drop to 4%. They're not going to want to continue paying at a 6% rate if they could call the bonds back and reissue it at a 4% rate. Does that make sense? So it's good for the issuer, not the best for the investor, because you have to end the agreement sooner than you anticipated. You may have been hoping to get more annual payments at the rate you liked, at a high rate that you enjoyed. So you want to remember call features, yield to call benefits the issuer. And then you have put features, which is the opposite of call features. Put features benefits the investor. It's where investors force issuers to pay off the bond before maturity. And that can occur when interest rates are high. So you could think before the 10 years are up in the bond agreement, you can force the company to pay off your loan before maturity. So let's say right now you're getting paid a nice coupon rate. Let's say instead of 6%, it's 9%. And while the interest rates are high, you want to just get as much as you can and just have the bond fully paid off while interest rates are high. And then bond prices and interest rates move oppositely. So you just want to think interest rates high means bond prices are low, and vice versa. Bond prices high means interest rates are low. Two opposite sides of a seesaw. And while those two are going up and down, opposite of each other, like a seesaw, the nominal yield is the point that never changes. Think of it as like the bolt that holds the seesaw together. The nominal yield never changes, but bond prices and interest rates change all the time in relation to each other. They move oppositely. And like you see in this chart, say you have the coupon rate And then at that very point of the triangle, the tippy top peak is the nominal yields. You could think it's the 6% rates or the 8% rate that the company determined before issuing the bonds. So that's the point that never changes. And then as you can see, depending if you purchase a bond at par value, at a premium, or at a discount, determines what your current yield would be, what your yield to maturity would be, and what your yield to call would be. So let's talk about if you were to purchase a bond at a discount. Purchasing a bond at a discount means you bought it for less than its par value. You purchase a bond for less than 1,000. So if you see a question mentioning, a $900 bond, an $850 bond, 900, 850 is less than 1,000. So you know it's being purchased at a discount. And since you know it's being purchased at a discount, then you know the order from lowest to highest would be the coupon would be the lowest at a discount, and then the current yield, followed by the yield to maturity, and then yield to call would be the highest if a bond was purchased at a discount. Discount means coupon rate lowest, yield to call the highest, and yield to maturity in the middle. Let's say a bond was trading at par. You bought it at par value. That means all things are equal. That means it's just trading at 1,000. So trading at par means all are equal. The coupon is equal to the current yield, equal to the yield to maturity, equal to yield to call. And if it's purchased at a premium, premium means the coupon rate would be the highest point, and then the yield to call would be the lowest, with yield to maturity in the middle. So purchasing at a premium, coupon is higher than yield to call. Yield to call is higher than yield to maturity. Yield to maturity is higher than yield to call. There are questions on the exam that look like you need a calculator for yield to maturity or yield to call, but if you just understand the order of purchasing at a discount versus purchasing at a premium or at par, you will not need to use any calculators for yield to maturity or yield to call. Then you have convertible bonds and zero coupon bonds. Convertible bonds are issued by corporate issuers, and it allows investors to convert the bond into shares of common stock. So if you're a bondholder, and let's say, the purpose of a bond is to get income more than it is to get ownership or growth. But let's say you're not really making much income off your bond, and you'd rather participate or would like to participate in more growth so you can get your money growing as much as possible. Then you could invest into a convertible bond that allows you to change the bond into shares of common stock, which is ownership. And common stock is all about growth and growing your money. And then you have zero coupon bonds. Zero coupon bonds are normally issued as interest paying securities. Normally, bonds are issued as interest paying securities, but zero coupon bonds are debt obligations that do not make regular interest payments. So normally bonds will pay you interest on an annual basis, but zero coupon means no annual interest payments. You want to remember, zero coupon is issued at a deep discount, and they're more volatile than other bonds with the same maturity. If zero coupon bonds don't pay interest annually, when do they pay interest? They only pay interest at maturity. So let's say you're like, oh, I want to save for college 10 years from now, then a zero coupon bond won't pay you any income until it reaches that 10th year, until maturity. But even though you're not going to get any annual income with this zero coupon bond, it's also important to keep in mind you still get taxed annually on interest that is not being paid to you. So even though there's no annual interest, you'll still get taxed on annual interest. The only time you'll actually receive that payment would be at maturity. A 6% corporate bond trading on a 7% basis is trading, you want to think, at a discount. If a bond has a feature that allows the issuer to pay off bondholders prior to maturity, the bond has a call feature. So a key word for that question will be allows the issuer. So you want to think call features benefit the issuer. It allows them to call off the bond agreement before maturity. It allows them to pay off your investment sooner than you would have thought, so that they can maybe reissue bonds at a lower rate. Call feature. When it comes to credit ratings, since bonds are all about lending money, IOUs, right? You also always want to connect credit with debt. And how good a company is when it comes to repaying you the money that you lended them determines what their rating would be. So bond ratings measures default risk. Default risk is simply a corporation or an issuer's inability to pay off their debts, to pay off their loans that were received. So it's very important to pick, the right company if you want to invest into their bonds. Because if they're a poorly graded company, then basically you can expect your investment not to be repaid anytime soon. It's like you lend the money to somebody doesn't have any money. When would you expect to actually get that return back? It'd be really hard to determine. So you have investment grade bonds, which are high quality bonds. Investment grade bonds, high quality bonds, are rated triple Bs, BAA, or triple A's. So you just want to think of it as like literally being graded in school. Good grades, high quality grades are considered B's and above. B's to A's is high quality investment grades. Junk bonds, which are high yields, you always want to remember high return comes with high risk. So high yield bonds, also known as junk bonds, comes with high risk. So that's any investment grade rated below the B's. Other names for junk bonds are speculative bonds, high yield debt. So those are examples of high risk. Is it possible to get a high return? Sure, but you're subject to high risk. And then, like I said, interest rate risk affects the prices of bonds. It's the risk that rising interest rates lowers bond prices. So you want to remember bonds can have default risk and interest rate risks, as well as call risks, where the issuer can pay off all the debt early and you didn't get a chance to collect any annual interest. Then you have secured versus unsecured debt. This is important to know when it comes to a company at dissolution, meaning if a company goes bankrupt, what would be the order? They would repay their investors. You always want to remember secured debt goes first. Any issuers will make sure they pay off all their secured debt holders before any other investors. So secured debt goes first to be repaid, followed by unsecured debt, followed by preferred stocks, and then common stocks holders would get paid last. What are the types of secured debts? You have mortgage bonds. Mortgage bonds are backed by real estate owned by corporations. You have equipment trust certificates, which are secured by equipment. So the name of them basically tells you how they're backed. Mortgage bonds are backed by real estate, so you can connect mortgage with real estate. Equipment trust certificates are backed by equipment of the corporation. And then collateral trust bonds are backed by a portfolio of securities held in a trust. Mortgage backed by real estate, equipment trust certificates backed by equipment, collateral trusts backed by securities held in a trust to secure the loan. So those will get paid out first before unsecured debt, preferred stock, or common stock gets paid if a company is going bankrupt. For unsecured debt, you have debentures, which is just another name for an unsecured bond. Basically, think these are backed by promises more than actual assets. These are mainly backed by promises. You have guaranteed bonds, which are as guaranteed as the guarantor. So once again, being backed by promises of the issuer or a third party, which is also known as the parent company. So a guaranteed bond is only as good as who's guaranteeing it. What parent company, what issuer is guaranteeing these bonds? Unsecured. And then you have income bonds, also called as adjustment bonds, only make interest payments when a company has enough income. So the name of the bond, income bonds, tells you what it does, which is pay income, pay interest, but only if the company has made enough income would they pay anything. And then you have subordinated debt. You want to think subordinated debt is sub debentures or below debentures when it comes to payouts, and carry a higher coupon rate because of additional risks. So subordinated debt carries a higher coupon rate. So there's different types of issuers of bonds, issuers of debt. You have corporate bonds, which is issued by businesses to fund operations. There's default risks with corporate bonds. Default risk is just a failure to pay interest or principal. So once again, if a company is unable to repay off their debts, that is default risk. And then you have more safer issuers like the US Treasuries. It's the safest debt backed by the government. So treasuries, anything that starts with a T, you could think it's a treasury security. So T-bills, T-notes, T-bonds are backed by the government. So they're the safest of the debts backed by the government. You want to remember they're all issued in book entry form. So the moment you see T bills, T notes, or T bonds, just think book entry and think T plus one for when they settle. T plus one. Trade date plus a day is the settlements. Then you have municipal bonds. Municipal is local or state governments. So you have U.S. treasuries, which is more federal level. And then you have municipal, which is state or local level. Another name for municipal bonds are munis, which is just local government debt. So your local town, your local county, can issue some bonds. Your local state. Some tax benefits with municipal bonds is that municipal bonds, the interest is free of federal taxation. So any bonds issued by munis, any bonds issued by state or local governments are free of federal taxation. They can still get taxed on the state level, but they're tax-free on the federal level. And then you have treasury receipts, which is more government securities. Treasury receipts are created by broker-dealers from T-notes and T-bonds. So they combine the two, you could think. Broker-dealers buy treasury securities, put them in a trust at the bank, and then sell separate receipts against the principal and coupon payments. So treasury receipts are just when broker-dealers buy T-notes and T-bonds, and then they put them in a trust at a bank and sell separate receipts from those for income. And then you have treasury strips, where securities with interest is stripped from the principal, making them two separate components. So let's say, you had 1,000 bonds with a 6% rate. They would separate the 1,000 principal and that 6% interest rate. They would strip the two apart and then make them two components that you could think are sold separately. Banks and broker dealers are the ones that do the stripping of the interest rates from the principal. So treasury strips are zero coupon bonds, meaning they do not pay any interest annually, and they are backed by the faith and credit of the government. And then you have TIPS, Treasury Inflation Protection Securities. You just want to think it protects you from inflation. It has different maturities of 5, 10, or 20 years. Comes with a fixed coupon rate. Pays interest every 6 months or semi-annually. It adjusts based on inflation rates. So you could think TIPS. Inflation protection does what the name says. It protects you from inflation by adjusting to inflation rates. Any questions that mention which can, let's say, protect you from inflation, or which would be a good idea to have if you're concerned about inflation? TIPS and common stock are the best when it comes to combating inflation rates. Common stock grows with inflation and TIPS adjust based on inflation. And then you have Government National Mortgage Association, Ginnie Mae, or GNMA. You can think Grandma. Ginnie Mae is a government-owned corporation. You want to remember Jeannie Mae is the only agency securities backed by the federal government. So this isn't a corporation. This is an agency, and this is the only agency backed by the federal government. Not only is it the only agency backed by the government, but it's also the only government securities that pays monthly. It's the only government securities that pays monthly. And then you have municipal bonds, which is local or state government securities issued by state and local governments. You remember are federally tax-free and taxed on state level. And that tax amount would basically be, depending on the state you're in. A few different types of municipal bonds you have are general obligation bonds, also known as GO bonds. GO bonds are issued to generate capital for infrastructures or property improvements that benefit the community. You remember GO bonds are backed by taxing power. So you could think, potholes in the roads, parks being built are funded through GO bonds. And then you have revenue bonds are used to finance a facility that generates income to pay the bonds. So revenue bonds are mainly for revenue to pay into the bonds. So revenue bonds, you want to remember, are self-supporting. Examples of revenue bonds you could think is housing, transportation, education, like dorms and books and stuff, health and sports, like a sports stadium generates revenue. So that revenue being generated is just to help pay the bonds, not to build around the community. Building around the community is for GO bonds. That's just a general obligation for your area that you live in to want to make sure you're living in the best area possible. Then you have tax equivalent yield, which is another calculation you would want to remember. For tax equivalent yield, to determine a municipal bond investment tax benefit, because remember, they're free of federal taxation. How do you calculate the tax equivalent yield? You would take the tax-free yield divided by 100% minus the investor's tax rate equals tax equivalent yields. Key point to know is municipal yields will always be less than corporate yields. Then you have some short-term debt, which is money markets. You remember money market is designed for short-term debt, short-term bonds. Mainly protects you from, interest rates because you're only holding it for a short period of time. So that is any debt maturing in 1 year or less. Characteristics of short-term debt, money market funds, they're highly liquid and they're safe. So you want to think they're safe from the volatility of the market because they're not going to be held for too long for interest rates to affect it. And since it's short-term, they're highly liquid. I mean, you can take that money out. Other types of short-term debt you have is commercial papers. You want to think commercial papers are short-term, unsecured corporate debt. You want to think commercial papers to be considered short-term have a lifespan of 1 to 270 days. And then you have jumbo CDs, certificates of deposit. For a jumbo CD to be jumbo, the minimum face value would be 100,000. And jumbo CDs mature in 1 year or less, making them short term. And then negotiable CDs are also considered money market instruments.